bunch of cute little boxes that companies kind of necessarily fit into. It's all relative, and this stuff is shifting, I think, pretty substantially over time. And so you got to be in the market, and you have to be talking to people. And I think the more you can say, hey, the more I can be self-reliant, the more I can get this thing done on my own, probably the better.
Yeah, that's awesome advice. Actually, I think that's something a lot of people don't think about is the fact that they are competing with everyone else and not just competing with their own metrics, because your metrics might suck compared to everyone else, and then your metrics don't matter. So one thing, so coming back around to, okay, let's say you have these great metrics and you want to get some funding. There's lots of different channels to get funding. Craig talked about friends and family as well as angel investors, and then we've got a few different levels here. We've got venture capital, which is what Nextworld does, as well as Sean, right? And Beau, you guys do venture capital as well as institutional investing too. Can you talk a little bit about?
Well, I guess I can tie in the bank here. Yeah. So from a venture perspective, we do venture very similar to these two here. As I said, primarily Series B. But then on the debt side, which is the other angle of Silicon Valley Bank, obviously, because it's a bank, they provide debt. So they'll do what we call early stage debt from 0 to 5 in revenue, 5 to 75 in revenue, and then 75 million and beyond. And then they'll provide different types of debt at those different stages. So it could be as small as $500,000. It could be in that middle category, $3 to $8 million. And then once you get north of 75 million, it could be 50 million to $200 million you could raise. So there's those different categories. And then we also have sub debt, and then we have mezz debt as well. And those companies are typically a little bit further along, typically between 40 and 75 million dollars in revenue. Typically, you're paying probably 15 to 20% type interest rates on those types of, including the warrants that come along with that. So there's the typical, SVB venture debt, if you want to call it that the bank provides. We currently have about 22,000 clients that we work with. We've got about an $18 billion loan portfolio. So we've been doing this for about 33 years. We're pretty much the market leader on the debt side. We've got a little bit over north of 50% market share today. So if you're a company that's ever raised venture capital and you go out and raise debt, north of 50% of those companies are actually getting it from Silicon Valley Bank.
And to kind of keep it on that for a second, can you explain the difference between that venture debt and venture capital funds? Because I think some people just don't understand.
Well, so venture capital,
it's not the same money.
You're buying equity in a business. So you're actually giving up ownership in your business, whereas debt is exactly that. It's debt. It's something you're signing up for. You're gonna pay that back, but we don't actually own any of your business. So that's the main difference between debt and equity. I don't know. You have a better answer?
Unless things go bad.
We don't want you. I can tell you what, our debt guys do not want your business. I promise you that. Because if it goes bad, it's usually a big zero anyway.
There's a
we don't repossess stuff.
Repo VC, that could be a real
A lot of ping pong tables.
5 cents on a dollar for that stuff.
That's the news in Silicon Valley Bank would love to see.
Silicon Valley, the aftermath.
Yeah, exactly. A lot of hair on chair.
There's another avenue as well. I know no one here is from that avenue, but corporate investors is another option. Anyone want to jump in and explain what corporate investment is? Great.
Sure. Corporate investment, you can find across that spectrum. It tends to be a little bit more conservative investment. They tend to not typically lead. That said, they will be very active if you're operating in their particular segment. So corporate investment is, until you get to a late stage, is usually accompanied by some sort of partnership or customer contract. They want to invest in you and see you grow because they're going to use your software for their national retail broker network or something. And they get this and they want the distribution rights or they want access to the early technology and innovation. It is an interesting place to go. It's a hard area to find, but you can just focus within your particular segment and find people that will really benefit from or could utilize that type of investment best way to think about it from an entrepreneur's perspective is go for the people who could be those amazing customers, get them bought in early with the customer contract and an equity investment that wraps it all into partnership and gives you stickiness on both.
Yeah, they've actually added a lot of capital to the market. We actually track a lot of the corporate venture groups. I believe it's something like north of 300 corporate venture groups have moved into the Bay Area in the last 2 years. So there's a lot of money out there. I mean, it's not all easy money. It's not all seed or Series A money. A lot of times it's follow along money. There are some groups that are doing more leading, and be a little more proactive. But it's generally tied to something strategic that's interesting to their business.
I want to add something to that because it's actually a strategy we employ a lot with some of our seed stage companies, especially in our Market Development Accelerator program, is if you have a developed technology that's actually defensible and you can create a competitive advantage for a customer segment in your marketplace, it's a wonderful way to raise money from a customer by making them pay you to develop your product. We call it NREs, non-recurring engineering expenses, non-recurring development expenses, and we've had a lot of success doing that with companies as opposed to spending time walking up and down Sound Hill Road. Just go directly to that company that sees this as a competitive advantage for them and cut an NRE deal. And when you're early stage and you're bootstrapping, a $70,000 or a $200,000 NRE deal can fund a lot of development.
What's NRE stand for?
Non-recurring engineering. Basically, he's paying you to develop your product. I mean, yeah, and I guess along those lines, I mean, it's great when you can do that because if you're a smart investor, you'll rely more on what a customer says than what another investor says. So exactly. I listen to customers 10x what I listen to another venture guy trying to sell me his deal.
Yeah, that's the whole point, because if the customer will pay you for it, then why go give up equity for it? And that's a great market indicator. So we look at that all day long when we're doing due diligence.
Yeah, and in some of these bigger plays, particularly in innovative fields, you need these corporate customers to really give you that initial market traction, because you may have to build out or supplement the solution to get it going. As an example, we just recently led a round for Airware, which is an enterprise commercial drone company. Great applications in insurance, energy companies, industrial companies, and so we closed a big round. We got, at the same time, announced big customer contracts and equity investment from, actually I don't know how many are public, but some of the number one or number two players in each of these segments. Those are that early inception revenue that gives you a great runway. And now you've got a partner who's developing this for you. So in Airware's case, this is tens of millions of dollars. So you can do this at the very earliest stage as well. Go to the corporates or strategics who will have an interest in benefiting from your solution as a partner, reseller, or even just a customer. Get them bought in early, and they'll like it because they get access to the innovation, they get access to Silicon Valley, and they get to help make sure that the solution that you're building is really going to meet the customer need.
Cool, so that's all my canned questions. So we're going to open it up to questions from the audience. Does anyone have questions for our panel? We got time for like one or two questions, so not too many. Anyone? John, in front.
So guys, a lot of you guys are A, B stage. I think a lot of the guys in this room are 0 minus 1 stage. Who fund the deals that get brought to you? Who are the angels? Who are the actual seed guys? Because as I've been going out, I've talked to seed stage guys and they're like, awesome, love this. When you have 10% month over month traction growth, come to me and I'll cut you a seed check, $500,000 for 20% of your company. And I'm like, okay, that used to be called Series C. And Craig's that, that's what that was,
Yeah.
which maybe you need to get out more because you're talking about the venture market from like 5 years ago. I mean, it has moved, but it's only moved in one direction, away from the entrepreneurs. So who's funding the beginning companies? Is it literally just people who have networks who will cut them $200,000 of checks? Because the guys in this room are here because they don't have tech guys who are going to write them $200,000 checks. They don't have those networks.
Right. I mean, some of it is network based, but honestly, the angel and early seed or pre-seed investors are out there. They're very hard to find because it's not as organized or transparent an industry as venture capital firms are. To put up websites and do that, it's mostly individuals or couples who do this. But you are actually in a very good time in the market cycle, because the last 3-4 years, there didn't used to be a big seed or angel ecosystem for those early inception deals. Now there is. There formalized things like Angel List and early angel groups, but there are a ton of angel investors, and you can find these things out if you go onto public sites like Crunchbase or whatever. Look at the early funding history. Look at those early funding announcements. Look at the ones that Series A where it'll be publicized. It'll say who the previous investors were. Sometimes you can find these things out. You can find enough of these groups. There are hundreds of them, and you're here in the world's epicenter of seed and angel funding. And frankly, a bunch of those guys do compete to go as early as they can. So they're inventing new terms. We're seed, now we're pre-seed, now we're pre-seed. We're not even a seed. We're just dirt. It's literally dirt. So you can find those things, but you have to be really scrappy, and it's really hard because it's not as organized.
Yeah, but there are lists on. You can just Google easily. You can get like top 50 angel investors in the Bay Area. You can find them that way. You can find the micro VCs. Angel List has these angel syndicates. There's things like that are happening. You can tie into those groups. But I would say if you don't have the network, it's all about hustle. You got to really bust your ass to figure it out. It's not going to come find you. I can promise you that. And the number one thing I've found that's the toughest thing for former military folks to do is go sell themselves and go sell their idea. And if you can't do it, you're never going to make it. You got to figure out how to make that transition to where you're willing to frickin' be out on the road, running around, convincing people and selling them that this is the best thing since sliced bread.
I'd also maybe add a tip. These guys, I think, correctly said that institutional money, corporate money can be useful. I think you can also apply that at the seed and angel stage. If, like, I'm a security company, if I know that my users and my economic buyers are going to be analysts and chief information security officers, see if you can get them to be angels in your company. That's a pretty powerful signal going into the next round, right? Because a lot of investors are going to look at that. They're going to kind of pattern match, right? They look at all these CISOs that invest in your company. It must be good. And it's going to make your path a lot easier. Hard to do, but really helpful if you can.
So just one more thing to add to that. You're absolutely right. These requirements for seed stage are shifting. They just shifted since we've had this conversation. And they will continue to, because in the age of applied technology, I can start a company. I raised $8.5 million for a company in 1999 that I could do the same MVP today for $400,000. So there's more money to be put across a wider swath of companies, and to drop little unicorn pellets in the herd and see which ones emerge, and learn from that. And people do that. I would treat your investor funnel the same way you treat your customer funnel. Develop an ideal investor profile on things like what Craig said. Industry expertise, domain expertise, people who might seek a competitive advantage, people who've won in a similar sector, have done this before, right? Get those people and hustle your ass off, just like you said. This isn't easy. This is really hard. Entrepreneur is a French word for crazy. It's hard.
And one thing that I'd add after, I've been part of